Hi, in this video I'm not going to discuss the current market of Bitcoin or the current market of Ethereum, but I want to dive into strategy. I want to dive into how do we navigate the market, how do we buy into the market, how do we sell, and what's a proper approach to optimize risk versus reward when getting into crypto. And I think there's kind of like an evolution here. So at the beginning, most people, they simply buy Bitcoin, right? They see this long-term Bitcoin chart. This is now the Bitcoin chart since 2010 on a logarithmic scale. So in the early days, you only have movements in cents. In the later days, in the hundreds of dollars, and now in the thousands of dollars. So this is a long-term logarithmic chart. If we look at this on a linear scale, this is how it looks like. Very different, right? So most people simply buy Bitcoin first. And then the longer you hold it, you're wondering what's up with all these other cryptocurrencies. And what comes up next is usually Ethereum. And so you buy some Ethereum. And I think that strategy in general is superior to simply just buying and holding Bitcoin, because the correlation between Ethereum and Bitcoin is not perfectly one, right? It's 0.75. So they don't always move into the same direction. There is a bit of a diversification benefit here. Say if Bitcoin moves in this kind of pattern and Ethereum mostly goes into the same direction, but not always, then when you combine this in a portfolio, you have a portfolio with less volatility, right? It tends to move in the same way, but sometimes the assets, they move in opposite directions. And so when you then combine them in a portfolio, your portfolio line has less volatility. It has less price movements, less ups and downs than if you would buy either only Bitcoin or only Ethereum. And so that strategy of combining them, of diversifying, does make sense. And so you end up with a portfolio of Bitcoin and Ethereum. Now the problem is, when you look at the historical Ethereum chart, you notice that the volatility can be very, very scary. When we look at the last crypto winter from January 2018 to December in the same year, we've got a temporary downturn of 95%. Now, even when you combine this in a portfolio, this looks still very, very scary, right? You don't want to lose basically all of your money within a year simply because you don't time this right. And so the next refinement to that strategy is to try to time the market somewhat, because it seems rather obvious, right? When there's a hype phase, a lot of random investments into new ICOs or into meme coins are made. When there's a depression, though, not a lot of people talk about crypto, right? So there seems to be a way to somehow time this, at least a little bit. But then the question is how? And so the next refinement to that strategy is to use a moving average. So you can use something like this, and you can maybe adjust the duration somewhat, make it a little bit longer maybe, and then try to buy into the market whenever the price is above the moving average and sell whenever the price is below the moving average. So you're outside of the market when everything is bearish, when prices tend to decline, but you're in the market when prices tend to increase. So that's the first timing strategy to avoid this 95% loss. Now the question is, what's the best moving average here, right? We can just take any kind of random moving average, but what's actually the best? And so this is where backtesting comes into play. When we backtest moving averages for Ethereum, we find out that the 23-day moving average and the 39-day moving average, they historically have been working the best. So when we exit the market, whenever the price is below the moving average, we are in cash. So this is the portfolio line. Whenever the price is above the moving average, we follow the market. So the 23-day moving average and the 39-day moving average, they both work pretty well. If you backtest several moving averages, that's the result you get. So that's one approach, right? But then why stop with daily moving averages? Why not trade on the hourly chart and kind of fine tune this? Now here are the results for the hourly moving average. We find out that the 91-hour moving average works the best. It works much better than simply buying and holding. So on the x-axis, you've got the moving average. On the y-axis, you've got the result of the backtest. So 91-hour moving average works very well. So what we could do is to set up a trading bot that buys and sells according to the 91-hour moving average. But the problem with this backtest here is that it didn't include any trading fees. And once we do that, once we include the trading fees, 0.1% per trade, the result of the 91-hour moving average isn't that great anymore. We barely beat buying and holding. This looks even worse when we look at decentralized exchanges such as Uniswap. where one trade can cost like 80 US dollars or so easily. So to get 0.1% trading fees in that case, you would need to deploy, say, 80,000 US dollars with every trade. And then the question is, what kind of slippage will you face? So probably in the end, the fee will still increase. You don't just pay gas, you also pay fees to the DEX. So how can we advance this? How can we actually make use of this result of getting better than average returns, of reducing the downturn from top to bottom? How can we refine the strategy further? Now, one way to refine this is to simply not use Ethereum. Ethereum's gas fees, they are insane. They're way too high, at least for really active trading. So instead, we can use a cheaper blockchain, such as Solana or Phantom. When trading on a decentralized exchange for Solana, for example, we've got fees for Radium of 0.25%, Symmetry has 0.22%, Serum has 0.2% fees. You can forget about the gas fees. They are on Solana less than a cent, so those don't really matter. But the trading fees, they are okay, right? They're at least okay for a decentralized exchange. This will solve the problem somewhat versus Ethereum. But still, this backtest over here was only with fees of 0.1%. That's the Binance centralized exchange fees. Now, I personally don't like centralized exchanges that much, at least for larger sums of money. And that's because you've got this third-party risk, right? You never know what's going to happen with Binance. Maybe they get hacked. Maybe they get outlawed. Maybe they do some kind of arbitrary KYC blocking and you just can't access your funds anymore. So I personally like decentralized exchanges way more. Holding all assets in self-hosted wallets, I think, is the way safer way. But how do we solve this issue of beating the market here? I think the solution lies in these periods of times when we are outside of the market and completely in cash. Because when you really think about it, right, when you are in an asset that tends to appreciate heavily over many, many years, say around 50% per annum or so, that's easily possible with Bitcoin or Ethereum. When you deal in such assets and you sell them, you really have to be pretty sure about your signal, right? Some people say you should never sell such an asset. You should simply buy it and hold it and completely endure the bearish market. Simply don't look at the asset or buy even more. But if you're not that kind of person, if you don't like your money to go down by 90 or 80%, then you probably want to trade. But being in cash, being on the sidelines also doesn't feel right. And so this is where DeFi comes into play. We already established that trading in and out of the market when you are on Solana or on Phantom is pretty cheap. But when you are in cash for a prolonged period of time, maybe you want to get yield on this. And the best yield that I could find, the best risk versus reward, was on a Phantom pool in Curve. Here the 2 pool with DAI and USDC, giving 13% per annum. In Phantom reward, you also get a little bit of Curve token. And on the base, so on the stablecoin, you get 0.6% per annum. So in total, you're getting around 16% per annum to be in cash. So that's on Phantom. On Solana, we've got something similar. On Orca, we've got this pool over here, USDC with USDT, which gives an annual return of 14.6%. Now, I personally like the pool of Phantom more because here you're only exposed to DAI, which is pretty safe, and the stablecoin of Coinbase and Circle. Here you are exposed to Tether. So if the stablecoin pack of Tether ever fails, your cash here will go completely to zero. You will lose all your money. So that's something to be aware of. So I like this way more. Now, what about all these other liquidity pools here? Say Solana, USDC, or Orca Solana. It gives 125%. Why not simply buy that? What's the risk here? The risk here is something called impermanent loss. So what you're doing is when you buy into such a liquidity pool, you provide, say, Ethereum or USDC for that pool. You pay that asset in, and then you own a share of the pool. And the return is generated via the decentralized exchange. So people go on the decentralized exchange, they swap back and forth, the fees occur, and the proceeds of those fees go to the people that provided the assets in the liquidity pool. So that's how this is generated. And so when you buy in, you're basically now holding a 50-50 bag of Ethereum and USDC. I am personally not really a fan of these kind of pools because you're still with half of your money in cash basically, right? So why even buy this? The other problem is impermanent loss, and that's when the valuation between the two assets in the pool diverges too much, say by 400%, then you will lose 20% on the money that you put in. So you're basically betting when you provide liquidity to a pool with assets that move in price, you're betting on the prices to over time, at least from the time when you pay in to the time when you withdraw. You're betting on the valuations of those two assets to be roughly stable over time, to not change too much. The reason why you lose money when those two assets diverge too much in price over time is due to the automated market making of those liquidity pools. It's basically the way how those DEXs operate, how the algorithms operate. They just adjust the prices based on demand and supply. And so when, say, Ethereum goes up a lot in price, then for a short period of time, the liquidity pool will sell the Ethereum for less than what's the fair price, because there's no real order book. There's no real external price source for the DEX. It's just simply based on demand and supply. And so when these assets move too much, you will lose money because there's basically a time lag in pricing the assets correctly. And so that's why the higher the volatility between two assets, the more return you get in these liquidity pools. But that's because you're potentially facing more of this impermanent loss. Now, when we look at the stable coins, you don't have that problem. You still get 14.6%, but the reason why you get this compensation here is probably because of the risk that Tether might go under at some point. And so that's why I like the Phantom stablecoin liquidity pool so much. There's no Tether risk here. There's no impermanent loss issue here. You really get this pretty much with zero risk. Of course, there's always risks of, say, a bug in the Curve protocol, a bug in the DAI protocol, but both of those are around for quite a while. So those contracts are probably pretty safe. So this return looks pretty good. And so if you would do a backtest now with the 39-day moving average, we would slightly appreciate here during these cash times. And maybe that return, that additional yield farming return, can even make up for the trading fees that occur when you buy and sell, say, based on the 91-hour moving average. So that's how I currently see this. That's the strategy I'm planning to implement. I haven't tried it yet. I first want to backtest. How does it really look like when you consider also the fees of depositing and withdrawing from Curve? I want to look more into the detailed numbers, backtest the yield return, backtest all transaction fees, maybe even look at staking rewards, because you do get some other tokens from the exchange here that you can stake, where you also get quite a bit of a return. So I'm planning to crunch all of those numbers. I'm also planning on making a tutorial of how to actually set all of these things up using MetaMask and maybe using a trading bot that executes the trades. So if you're interested in that knowledge, feel free to subscribe. I publish videos regularly. Feel free to subscribe. And of course, a like on this video would help as well. It will help the channel grow. Last but not least, you can join our Telegram channel. We are almost 800 people now. We enjoy discussing altcoins. We enjoy discussing the general crypto market. We also do some backtesting in that group, share results. So you can find us either by clicking the link in the video description or simply by searching for Bitcoin Strategy channel within the Telegram app. See you next time. Bye-bye.